Retail investors celebrating seven-figure gains on single stock bets are the canaries in the coal mine for a system running on pure narrative physics. That Reddit post about turning $36,000 into $1 million with Nvidia isn't inspirational. It's a flashing red signal that market dynamics have detached from fundamental reality. The S&P 500's 17% year-to-date rally amid geopolitical chaos, tariff threats, and Fed hawkishness confirms it. We're witnessing the third phase of a speculative supercycle where traditional risk indicators no longer function. The death of price discovery. Trump's proposed 60% tariffs on Chinese imports should have triggered at least a 5% market correction based on 2018-2019 sensitivity models. Instead, the S&P 500 rallied 0.8% the day after the announcement. This isn't resilience, it's market psychosis. Institutional algos now front-run retail flow rather than economic data, creating a self-reinforcing loop where 1. Retail FOMO chases momentum, Nvidia, SMCI, Bitcoin 2. Quant funds deploy leverage to ride the trend 3. Volatility suppression from zero DTE options creates a synthetic floor. The result? A market that climbs because it's climbing. The VIX hasn't sustained above 16 for more than 3 days in 2024, despite Middle East conflict escalation, 10-year Treasury yields spiking to 4.35%, commercial real estate imploding, NYCB minus 60% YTD. Japan's investing fever is a warning, not a model. The Economist's piece on Japan's retail trading boom misses the structural danger. Individual investors now dominate 70% of Tokyo Stock Exchange trading volume, a mirror of the 1989 bubble when retail participation peaked before the Nikkei's 60% crash. Key parallels: leverage ratios at 5-to-1 versus 3-to-1 in U.S. retail accounts. Focus on story stocks, semiconductor-related issues up 300% plus in 6 months, central bank manipulation. BOJ owns 50% of Japanese ETFs. This isn't organic demand, it's a liquidity trap. When the BOJ inevitably tightens, the unwind will make the U.S. meme stock collapse look orderly. The AI narrative is replacing interest rates as market fuel. Nvidia's $1.7 trillion valuation now exceeds the entire energy sector's market cap. The math is impossible. $60 billion in projected 2024 revenue equals 28x sales multiple, requires 50% annual growth for 5 years to justify valuation. Yet the stock keeps rising because the market has stopped valuing companies and started valuing dreams. The AI bubble differs from 2000's dot-com mania in one critical way: zero interest rates aren't driving it. Even with the Fed funds rate at 5.25%, investors are piling into speculative tech because there are no alternatives. Bonds offer negative real yields. Passive flows dominate price action. 60% of trading is ETF related. Short sellers have been wiped out. $12 billion in losses YTD. The coming catalyst: liquidity withdrawal. The Fed's QT is quietly draining $95 billion per month from markets, yet the impact has been masked by TGA drawdowns, soar $100 billion in 2023, reverse repo facility runoff, $1.8 trillion right pointing arrow $500 billion. When these liquidity buffers exhaust, likely by Q3 2024, the real stress begins. Watch for credit spreads blowing out, high-yield debt already showing cracks, VIX term structure inverting, front-month volatility spikes, mega-cap tech diverging from small caps, Russell 2000 down 5% in April while Nasdaq rises. Actionable conclusions. 1. Rotate into cash-rich value plays, energy, healthcare, with actual free cash flow. 2. Short the AI hype cycle via long-dated puts on Nvidia, SMCI, ARM. 3. Prepare for October volatility. Historical QT lag effects hit 18 months after rate hikes. The Nvidia Millionaires story is not a triumph of investing. It's proof we're in the greed phase of a bubble where fundamentals no longer matter. When the music stops, the exits will be crowded. Position accordingly.